Sweet rate relief, or is it? Let's talk about it on Today in Mortgages. Hey, what's going on, Dreammakers? Welcome back to the show. We're talking about what's real, what's hype, and what we should actually be paying attention to out there in the world of mortgage and real estate news. Rich, you're back. You took a week off, kind of at the worst time, but hey, we're glad to have you back.
Yeah, I had to move my second daughter into her apartment at college, so
Hey, family
that's
first.
it. That's it for the
Family
year.
first. That's what we always say at the network. So it's a good thing to have done. But Rich, while you were gone, Fed came out. We had a rate drop last week. Tell us a little bit what happened in case anyone had their head in the sand, and then we'll get into this article that you sent me from Market Watch.
Well, the industry widely expected a cut. I mean, pretty much knew it was already baked into price that we were going to see at minimum a 25 basis points reduction in the Fed rate. But there were a lot of people that expected 50. So we didn't get what we hoped, that we get a bigger one, but we got 25 basis points, which seems kind of reasonable right now, because I know, some news, sources are saying that inflation is under control. I think it's not what it used to be, definitely, but we're still 2.9. I mean, that's still elevated. So I think what has happened, because rates have gotten worse, Michael. I mean, they're 15 basis points worse after the cut.
Even though you say rates, Rich, you're talking about actual mortgage rates.
Mortgage rates, yeah. And just so everybody knows, and I think many in our industry understand that mortgage rates, they don't tie into the Fed rate. Mortgage rates generally follow the trajectory of a 10-year treasury, so the 10-year note. And so that's kind of where the 10-year note went up. And so interest rates just followed.
Well, and Rich, we saw this last time that the Fed cut rates. We had been in this waiting period for what felt like forever, for years. Rates were going up. They stayed there forever. We were eagerly anticipating that rate cut, and then rates were cut, and our actual street rate for mortgages went up. So coming into this rate cut, I think we were all a little bit more cautious, but maybe hopeful that we would see further rate decreases that we had seen leading up to this cut. But that's not what happened, is it, Rich?
No, I mean, in the messages, the initial rate cut is like, woo, yeah, okay, Fed cut the rate. But then, you get the Fed Chair Powell talks, and then the market digests what he says. And we've mentioned this several times. They hang on every little word. But the bigger issues still are out there. We've got worsening employment, and inflation is still not at that 2% range where the Fed wants it. So, investors get anxious, especially the ones that are in long-term bonds. Those investors don't want to see rates come down. They want that return on those bonds. And those bonds, long-term, compete with mortgage-backed securities. So as one goes up, the other one has to go up too. So mortgage-backed securities, in order to compete for that investor, if the 10-year goes up, so does mortgage-backed securities, which is interest rate. If the investors need a higher return, interest rates have to go up. Mortgage interest rates must go up to compete.
Rich, you mentioned skittish investors, and we haven't even talked about something we talked about a couple of weeks ago, which is reliance on this data that we don't really know if it's right or not. We had that huge job revision a couple of weeks ago.
Yeah, they're really concerned. The Fed is really concerned on if they lower too much, then things get out of hand again. So that's the fear. That's the fear in the markets too, the investors. Where we go from here, I don't know. I've read 4 pieces just in the last 20 minutes, and nobody knows. Nobody knows what's going to happen. So, here's what we do know. Rates have been coming down gradually. We got to the lowest point Wednesday prior to the Fed cut. Rates were at its lowest point in like 2.5 years. So we are coming down. It doesn't always have to do with what the Fed is doing. It's what the market is willing to do. And just follow the 10-year treasury. That's where most of us in the industry, that's where we look to see what's happening. When that 10-year treasury drops below 4%, we're going to see lower interest rates. As long as it stays elevated in the fours, we're likely going to stay where we are.
Rich, you mentioned Fed Chair Powell's comments, and one of the things that he did say, one of the things that we do know, is that there is some hope and idea, and maybe we'll wait and see that there might be a few more cuts this year. Rich, if those things do happen, are those things already baked in, or do we think we will see some difference in the street rate after those cuts?
Oh, man, I don't know, Michael. I just consume this data and try to make the best out of it with my experience. I don't know. I just don't know. What I do know, like I mentioned before, is rates have gradually been coming down. They're just not coming down in big steps. They're like tiny little choppy steps. So, and they come down, they go back up based on some economic news. But as you know, in my history, as employment weakens, generally that the economy softens, interest rates for mortgages come down. So we are seeing some softening in the employment area. So maybe we see interest rates continue to come down.
Yeah, Rich, it is definitely a battle of different indicators out there. And so everything that we're seeing is kind of playing against each other. And like you said, it is evening things out. So we're not seeing a lot of that rate relief in mortgages that we had hoped. But we do keep looking forward here at Network Funding. So, Rich, what are the things that we're concentrating here at the network?
Well, that's it. We're just trying to qualify our borrowers on today's interest rates by using all kinds of tools, great products, great builder relationships. It's all we can do today is to help our borrowers qualify using the right products at great terms.
And Rich, you're always doing a great job of educating us here at the network so that we can then in turn educate our customers, clients, and borrowers. So if you guys are out there looking for a new place to hang your hat where you can grow leading into 2026 as we hopefully see some more of these cuts come and you're ready to capitalize on that market, reach out to Rich through the grow link below. That's u.nflp.com to learn how you can become your best you at the network. Rich, any final words that you have on anything that happened last week with the Fed?
I would just say to all borrowers, our realtor partners, and loan officers in our industry, things are getting better. Let's stay focused on that. Things are getting better for our borrowers and our real estate partners. So just stay focused, educate yourself, educate your referral partners and your clients on product, and things will get better.
To win, you got to be the best, and that's what we foster here at the network. Rich, you're the best. Thanks for joining us again here. Thanks everyone out there for watching and listening. Wherever you are, we appreciate you, and we'll see you next time on Today in Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates, and any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.